Hi everyone, this is Aman Bajaj and I welcome you to this video. Today we'll be discussing mutual funds. So by the end of this video, we'll be able to understand the concept of mutual funds. You'll be enticed to invest in a few of them, and I'll give you my 2 cents about a few mutual funds where you can invest being a passive investor. So let's see. Okay, so let's talk about investments. So when I say the term investments, what are the things that come to your mind? Fixed deposits, real estate, recurring deposits, or chit fund or BC. That's it. That's where we stop. We refrain from going towards the term share market. Why? Maybe because we've heard that, maybe because uska naam itna kharab hai, maybe because our parents told so, because there are share markets means losses and market crashes, etc. Or maybe because we have little to no knowledge about share market. So what if I tell you that there is a way where you can contribute to the profits of share markets without gaining the entire knowledge about share market? Yes, there is a way, and that way is called a mutual fund. So mutual fund is actually a vehicle for small investors who wish to invest in the share market. It is an entity which collects money from small investors, pools it together and invests it into various securities like equity, debentures, money market government securities, and other funds. Other funds like which are mutual funds, other mutual funds. Okay, so now that we've understood that what is a mutual fund, let's see how it works. So the investors pool their money together and give it to the mutual fund. This mutual fund appoints a fund manager who is an expert in the field of stock market. He has the knowledge, the expertise, the experience required to make the buy, sell and hold decisions in the share market. So this fund manager makes the investment decisions on behalf of these investors and invests in securities. These securities generate returns, which are then passed on to the investors. So as an investor, what do you earn from a mutual fund? So the next thing in your mind will be, what does an investor get? As an investor, your returns comprise of dividends and price appreciation. Let's talk about dividends first. Dividends is basically the distributed income which is earned by a mutual fund, which is distributed amongst the various investors. It may be 1 rupee per unit or 10 rupee per unit. That varies from fund to fund. And then you have the price appreciation. Now, what is price appreciation? So as you know, for stocks, there are the market prices of shares. So a market price of a mutual fund's unit is called as a net asset value or NAV. There is a change in NAV because it is calculated at the end of each day, and it is based on the performance of the stocks which are invested in by the mutual fund. So that change is also a return for the investors who have invested in the fund. Now let's talk about the advantages of investing in a mutual fund. The key to stock market investment is diversification. A well-diversified portfolio normally contains in it about 10 stocks, as suggested by Warren Buffett in an interview. So let's assume if an individual investor has to buy, say, 100 shares of each of the selected 10 stocks, it could cost him about rupees 5 to 7 lakh rupees. However, when he invests in a mutual fund for as a small sum of, say, you can say 5,000 or 10,000 rupees, he gets instant diversification at a fraction of this cost. This is because as a unit holder, he becomes part owner of the stocks that the mutual fund holds. In short, mutual funds help him buy diversification off of the shelf. Mutual funds provide liquidity. The same cannot be said of the investments in fixed deposit or stocks. For fixed deposits, you have to wait for the maturity date. Professional management, as we spoke about it earlier, a small investor does not have the time, the inclination or the expertise to manage his own money. The mutual funds are run by professionals who are experts in the field of investment management, like chartered accountants are trained in the field of auditing. Fund managers are trained in the area of capital market investments. Yes, they have formally studied fundamental analysis, technical analysis, value investing, etc. Your money is therefore in the hands of experts and hence in safe hands. Through a mutual fund as an investment vehicle, you can invest in instruments that you could not otherwise have invested. For example, it may not be possible for an individual to invest in the government securities and bond markets where the minimum investment criteria is very large, say about rupees 10 lakh. Also, most bond issuers today hardly invite the retail investor to invest. So, as a retail investor, mutual fund is the place to be. The mutual fund industry is highly regulated. There is a self-regulatory organization called the Association of Mutual Funds of India, whose role is to define and maintain high professional and ethical standards in all areas of operation of the mutual fund industry. This includes promoting the best business practices and the code of conduct to be followed by the members. Their presence ensures that the industry plays according to the rules of the game. And then we have SEBI as the watchdog of the industry, which makes sure that the securities market in the country is well regulated and there are no frauds taking place in the industry. Okay, just for the record, this is not a sponsored video, and all of these advantages, they all come at a cost. And as a wise man once said, that there is no such thing as a free lunch in the world. Everything comes at a cost, and the cost for a mutual fund is the professional fees which a mutual fund charges. This fees is denoted in the offer document of the mutual fund scheme. The costs associated with the mutual fund are under the style of an expense ratio, and apart from the expense ratio, there is an entry load and an exit load. So since the past few years, you can say 5 or 7 years, SEBI has brought down the entry loads to 0 rupees. So basically, you can freely enter the mutual fund scheme, but while exiting, there may be charged some loads, which are known as the exit loads. Okay. Let's talk about expense ratio, as it is a key factor in the case of mutual funds. So expense ratio is basically expressed in the terms of a percentage, and it is a fees which a mutual fund charges you for managing your portfolio. So let's assume that you are investing 10,000 rupees in a mutual fund with an expense ratio of 1.5%. You are actually paying an annual fee of rupees 150 to the mutual fund for managing your portfolio. Since this is charged regularly, a higher expense ratio over the long term may actually eat up your returns. So while selecting a mutual fund, you're always supposed to go for the one which has a lower expense ratio. And this expense ratio is also regulated by SEBI. You cannot charge beyond a certain point. It's around 2 to 3% is the upper limit in that case. So let's take an example that you invest 1 lakh rupees for 10 years and the mutual fund gives you a return of 15%. So at the end of the 10th year, you will be having returns of 4 lakh rupees. Now this is without the expense ratio coming into play. Once an expense ratio comes into play, say suppose 1.5%, your actual returns will actually fall to 3,50,000. So this extra 50,000 which you have lost over the period of 10 years is because of the expense ratio. That is why it becomes a core factor while investing in the mutual fund to pay attention to expense ratio. So let's say you're ready to invest in a mutual fund. You go to the mutual fund's website, whichever you like, and then you'll come across there will be 2 types of plans in every kind of mutual fund scheme. Let's take for example Tata Banking and Finance Fund. So there will be 2 types in that. One will be Tata Finance and Banking Fund Dividend, and one will be Tata Finance and Banking Growth. So which one do you select? In the dividend plan, basically what happens is whenever a dividend is announced by the mutual fund, that will be paid back to you regularly, let's say once a year, whenever the periodicity comes in. And under the growth model, what will happen is that dividend amount will be reinvested at the NAV prevailing at the date of the announcement of the dividend. So basically dividend you'll get in both plans, but in the growth plan it will be reinvested, which is actually better for the long term because that dividend will get multiplied by the power of compounding. So this was about the basics of mutual fund, which you must know before you try to invest in a mutual fund. I'm sure you'll be tempted by now to go to the site of MV and check out the best mutual funds available in the market. So I'll just give you a few advices from my end, that how do you pick winners, or you can say the best funds, on the basis of a few pointers which I have listed down for you. So let's see. Past performance. Check the performance across various market turns. The past performance of a mutual fund plays a very important role. You need to check the past performance of any fund which you are investing. A good track record always helps you. Timing. Good time to enter the market would be, you can say, right now when the markets are down, because you will be buying at a lower price, and then later on when the market goes up, you can sell and exit and thereby make a profit. Another thing, the size of the mutual fund scheme. Larger the size, greater will be the economies of scale. Age. The longer the fund has been in the business, the better. Fund manager. Now this is a crucial point. Funds are managed by the fund managers, as we already studied. Their track record is crucial. You will always see in a scheme document that the fund manager's profile will be given. Go through it carefully before actually making your decision. Expense ratio, as we said, lower the better. Yeah, I've put a asterisk there because conditions apply, because generally what happens is the better funds, you can say the bigger funds, actually also have a high expense ratio, but their track record is really good. So don't just judge on the basis of expense ratio. Take a note of all the other factors as we have listed. The portfolio turnover. Now the portfolio turnover means it should not be too high, because we can it makes the fund actually a bit more fluctuating, but it should not be lower, because it shows that many opportunities might be missed by the fund manager. So it should be just right. Okay, next up we'll have largest holding. The performance of the largest holdings in the scheme is critical. For example, a fund invests, say, suppose 50% of its holdings in a single share, say like Reliance. So it becomes necessary that how that share is performing, because ultimately the returns will be dependent upon the returns of the securities or the stocks in which they are invested in. So although the fund manager is supposed to make all these decisions, you can make an informed decision by your limited knowledge, that how a mutual fund will perform. And lastly, we have the PE ratio. PE ratio is basically the price to earnings ratio, which is the most important factor to be considered in while investing in the stock market. So even that needs to be understood. So before wrapping up the session, I would like to share a quote with you. We might have heard this from our parents, that money does not grow on trees. What I say is, money indeed grows on trees, only we call these trees as investments. Because just savings are not important. You need to make your money work by itself, and investments are the way to do that. And that's it for now. Okay, yeah, I have not forgotten. I will be sharing my 2 cents with you, a suggestion from my end. So if you want to start right away with the investments in mutual funds, what you can do is invest in index funds. So what are index funds? Index funds are the mutual funds which invest in the indices of the country. What are the indices of the country? For India, it's the Sensex and the Nifty 50. So what this fund will do is invest in the companies which comprise of the indices of the country. These will be the top companies of the country, like the blue chip companies, which we call them. You can try investing in them. Okay, so here we wrap up our session on mutual funds. I hope you enjoyed the lecture, and I hope you have become somewhat financially literate. And if you like this video, please give it a thumbs up. Make sure to subscribe to the channel, and if you feel like this can be a useful video for somebody, please share the video. And if you have any doubts or you need any clarification, please drop a comment. I'll make sure to reply to that comment. And if you want me to take up another topic for discussion, please drop a comment. I'll make sure to consider your recommendation. Thank you so much.